Thank you, Yari. Hello, everyone. My name is Vahan Malakian. I'm the real estate loan officer here at Foothill Credit Union. Really excited to have you all here for our second home buying seminar for the year. I hope you're all relaxing at home, maybe with a cup of wine or coffee, or maybe something stronger, depending on your day. But we're going to do our best to get through this without boring you too much and without me rambling as much. And like Yari mentioned, please save your questions towards the end and put it in the chat box, and we're going to definitely answer them at the end of the presentation. With that being said, let's get started. All right, so one of the most common questions I'm asked with first-time homebuyers is, Vahan, where do we start? We don't know what to do. Want to buy a house, it's a big investment. For most, it's going to be the biggest investment you make. So where do we start? The goal of this presentation is by the end of this, you should have a good idea of how to get going with this pre-approval process, pre-qual. We're going to cover all that. We're going to first talk a little bit about your credit scores, how to keep good credit, maintain your scores, maybe help you get a little bit higher scores, what the pre-approval process entails, different mortgage types, fixed rates versus adjustables, touch a little bit on interest rate trends, what mortgage insurance is and impounds, what escrow does, what title does, what real estate agents do or realtors do, and the general homeownership timeline. So our first topic is credit scores. So I typically say you need three things to buy a house nowadays. So one of them is income. We're looking for a 2-year employment history, working in the same line of work. So like, for example, if you're an RN, you were at one hospital, you go to another hospital, but you're still an RN, that's totally fine. So we need 2 years employment history in the same line of work. It could be different companies. The second part is down payment. We'll touch a little bit on that later. You need anywhere between 3 to 5% down. And the third part, which is a big chunk of it, is your credit scores, or are your credit scores. Now, credit scores can range anywhere from as low as 300 up to 850. In our world, the higher the credit scores, the better. Typically 740 or above is going to give you the best deals on interest rates, PMI, overall better options. Not to say if your credit's a little bit lower in the mid sixes, doesn't mean you can't get a loan, but if you want the better option, the better deals, we'll try to get your scores up a little bit. Now, how does credit work? I wish there was a straightforward black and white way of saying, do this, your credit's going to be this, but unfortunately, that's not the way it works. Now, the number one thing is payment history. Make your payments on time. Pretty straightforward with that. When we're looking at credit, installment loans, personal loans, student loans, any sort of agreed upon term, make your payments on time, everything's going to be fine with your credit. Credit cards, however, are a little different. Now, credit cards are revolving accounts every single month. Credit agencies are being reported to, showing what your balances are on the credit cards versus your credit limit. Now, typically, I suggest, and we're going to focus a little bit more on credit cards, because again, personal loans, student loans, they're all treated different. Make your payments on time, you'll be fine. But with credit cards, ideally, you'd want to pay off your credit cards every single month. Now, easier said than done. If you've racked up some of your credit cards, sometimes it's harder to bring those balances down. But let's say you can't pay off the credit card at the end of the month. Try to at least bring the balance below 30% of your credit limit. Now, you're going to need to roll that over. Now, typically, credit reporting happens towards the end of the month, at the beginning of the month, within the first 5 days or so. What I suggest is if you can get to a point where your credit cards, you've wiped them all out, you take one good credit card, whether it be by yourself or with a spouse, and you use your credit card for everything, your monthly expenses, right? So like we're talking gas, food, groceries, going out, whatever the case, you're going to spend your money on that anyways. Charge it on a credit card. You get a good credit card with cash back points. You get benefits from both sides, right? And at the end of the month, take your cash, pay it all off, or pay it down to a very small balance. This way, credit reporting happens at the beginning of the month. It shows that you have a lot of credit available. So the amount owed really really matters here. And credit's constantly moving. It's never going to be consistent. One month it could be up a few points, one month it could be down. But practicing these habits are going to eventually, over time, help your credit scores to be in the high 700s. Length of credit history also matters. Some of us that are just starting out, our parents might have opened a credit card for us, or if we're an authorized user on their account, whatever we can establish credit history on, the more the better, essentially. And again, sometimes it's with age. If you haven't had credit, you want to borrow, pay back, and over time, you're going to see your credit scores increase. Types of credit used also is a portion of it. So we're looking to see, do you have credit cards, installment loans, personal loans, whatever, car loans, student loans, and are you obtaining new credit? That's also another factor. So it's kind of like, well, you need to spend money, borrow money to have good credit scores, but there's a smart way of doing this is charging your credit cards and paying them off every single month. Um, with that being said, let's go on to the next slide. The do's and don'ts while house hunting. So when we first meet, when we do a pre-approval, when we're looking at your accounts, we're basically going to verify it all. So we want you to keep all your accounts current during this process. I'm gonna look at your bank statements. We're going to take your pay stubs. We're going to look at everything essentially. So make your payments on time, keep your accounts current is the number one thing. We don't want any surprises. Some of you may have heard, this process was a headache, it was a nightmare. I do my best to make this an easy process for you, and I strongly believe that who you work with will make all the difference. So if we meet, we run the credit once, it's not going to be updated for another 60 days. We want to make sure you keep everything current. So when I run your credit again, if we need to, we're not going to have any surprises. Your scores aren't going to drop or whatever the case. Please keep all the currency in the bank. So part of buying a home is your down payment. So we're going to need to verify that you have this money. It's been sitting in your account, whether it be a saving account or a checking account, it could be in your 401k. The money has to be in the bank. Please do not take it out, put it away in a home safe or whatever the case. We want to make sure whatever you put forward, whatever you show that you're going to use for the down stays in the bank. But also, please don't move money around. But we're gonna talk about the don'ts in a second. Do contact both your lender and your realtor anytime you have any questions. Now we're here to help. I can speak on my behalf only that this is a process not a lot of you, well, most of you probably haven't gone through. So there's going to be a lot of questions involved, and I'm going to encourage you to call me or send me a message, whatever the case. Ask as many questions as possible. This is a learning process as well, and I'm going to do my best to guide you through it all. So please contact us and your real estate agent or realtor anytime you have a question. Please return your phone calls sooner than later. When your offer is accepted somewhere, typically it's a 30-day window where we're going to close the loan. So there's going to be a lot of back and forth, especially the first week or so. I'm going to have some questions. I'm going to have paperwork for you to sign. Your realtor is going to have some paperwork for sign. Escrow officer. There's going to be a lot going on, and we understand. We all work. If you can't call right away, do your best to call us back sooner than later. Sometimes there's time-sensitive information or a question we need answered. So yes, do your best to give us a call sooner than later and provide all the necessary paperwork. And again, when we first meet, it may take you 20 days, 30 days, 60 days to find a home. So you're going to provide paperwork to me at the beginning, but once your offer is accepted somewhere, I need to update those papers. So if it's pay stubs, I'm going to ask for updated paycheck stubs, updated bank statements. Please, it's very important within that first week, provide all the necessary paperwork that we're asking from you. The don'ts while house hunting. Now, this is important. I understand life happens, but please don't quit or change jobs. Now, if this is likely to happen, it's better you talk to me about it or give me the heads up. We want to make sure, or I want to make sure, there aren't any surprises when your offer is accepted. And again, it may take you 30 days. You might take you 2 months, it may take you a year. I've had people I worked with for 6 months. Communication is key here. If you're changing jobs, still staying in the same line of work, maybe getting a increase in pay, let me know, even better. That might help you qualify for more. Or if you're going to take a pay cut, or if you're going to go on maternity leave or anything like that, please, the more transparent you are up front, the better prepared we'll be to make this process much easier for you and overall a good experience. And that's my ultimate goal. Please try not to run credit, apply for new credit, credit cards, whatever the case. But again, life happens, car breaks down, something you need right away. Again, transparency is key. Call me, send me a message. We'll discuss what the options are and if it's going to hurt your qualifications or the pre-approval. Please don't change bank accounts or transfer money within accounts. In the beginning, again, we meet, we're going to give you some paperwork. We're going to basically take those bank statements and say, this is the money we're going to use for the down. When the offer is accepted and we look at that same bank account and notice some money being transferred to another account or between accounts, I'm going to have to follow that money. And that's going to be a lot more paperwork for you. So it's easiest if we keep it all in one place, or if you have it 2 different places, wherever you present in the beginning, please keep the money there. Of course, you could add to it, but if you start moving money around, it's going to make it more of us chasing documents down. And this is where, in my experience, it becomes somewhat of a stressful process. And the goal is to make this not a stressful process. So, and purchasing, same thing there. If you're going to purchase something, please let me know. Ideally, don't. Sometimes your credit can be affected by adding new debt temporarily. And if your offer is accepted right around that time, we run credit again for whatever reason, scores drop, it's going to hurt our qualifying. So I don't like surprises, and I don't want you to be surprised with anything. So please, communication is key here. All right, the pre-approval process. So there's pre-qualification and there's pre-approval. So we don't come across pre-qualifications often anymore, but imagine a pre-qualification is basically you calling me and telling me, okay, this is my income, this is what I have for the down, this is my credit score, what can I qualify for? And I'll run the numbers and ballpark tell you this is what you can qualify for. There's no official letter, there's no official application, there's basically nothing. It's just verbal telling you this is what you can qualify for. Nowadays, if you're serious about buying a home and you're going to be out there shopping around, you need what's called a pre-approval letter. And if some of you have spoken to real estate agents, one of the first questions they probably would ask you is, have you been pre-approved by your lender? So your first stop is us. Talk to us first. The pre-approval is more in depth. So I'm going to take your income, tax returns, W-2s, pay stubs. I'm going to look at your bank statements, make sure we have enough for the down or 401k, or if the money is being gifted from somewhere else. And I'm going to run your credit, and putting all of that together, it's going to give me a good idea of what you can qualify for. I've done my due diligence, so I'm going to give you a pre-approval letter. And the pre-approval letter is typically good for 60 days. So with this letter, you'll say you're approved up to X amount. Doesn't mean you have to take that amount. It just shows that you're able to go that high. And you'll take that letter to your realtor or real estate agent, and this will allow you to start shopping around for homes. Because sometimes nowadays, they won't even let you see a house unless you have a pre-approval letter. So we're gonna want you to get pre-approved first, not necessarily pre-qualified or pre-qualification. This is our homepage. It's a way to get a hold of me. I'll give you all my information at the end of this too. But when you're on our homepage under the tabs loans, you can go in and just hit apply now. When you apply for a pre-approval, I want you folks to imagine there's nothing really starts on my end. We don't have a loan just yet. I mean, it says apply now, but it doesn't necessarily mean you're going through with this. It's me getting your information, calling you, running credit, getting income, putting everything together. The loan doesn't start until your offer is accepted somewhere. So imagine that could be, again, a month, 2 months, 6 months, just depends. And knowing this market, sometimes taking a little bit longer, or whatever the case, go to our homepage. You can submit your information from there, hit that apply now, and I'll be in touch within the next 24 hours to go over your scenario. All right, we have different mortgage types. Well, the two main mortgage types out there is fixed rate mortgage, and then there's adjustable rate mortgages. With a fixed rate mortgage, pretty straightforward. The rate is locked in for the term of the loan. So the most common fixed rate is the 30-year fixed. It gives you the longest term available, lowest monthly payments possible. And for first-time home buyers, this is the go-to. Now we have 20-year fixed and 15-year fixed options as well. But the shorter the term of the loan, the higher your payment is. So like I said, most first-time home buyers will go with the 30-year fixed. The principal and interest payment, so the payment to the loan, will never change once it's locked in. It's easy to budget for, kind of know what to expect moving forward, and it's ideal if you're looking to stay in that house long term, 10 plus years. Also, of course, it's safe from economic volatility, markets going up and down. Most people will go with the fixed rate mortgage first time around. Now with the adjustable rate, the interest rate will be fixed for a certain period, right? So it's considered an adjustable, but it's fixed, let's say, for the first 3 years or 5 years or 7 years or 10 years. Then we'll adjust. And depending on the type of adjustable you get, the adjustments can either occur monthly or quarterly or semi-annually or annually. There's a lot of different adjustable rate or programs out there. So it all depends on the lender you're working with. The good thing about the adjustable rate mortgage, call it a good thing, is the rates tend to be a little bit lower than a fixed rate mortgage. They've always been the case. There's more risk involved. So if, for example, the 30-year fixed is around 4%, the adjustable 10-year fixed would be closer to maybe 3.5, 3.3%. And again, not as much of a common for first-time home buyers to go with this. It's riskier, but it is available. And we can discuss your scenario one-on-one when you call me. We'll run some numbers and compare the differences. But the interest rate is usually determined of two factors. There's an index and then the margin. The margin is based on your qualifications, right? So your credit score, how much down you're putting, and the index is what adjusts. And if the time comes, you're going to take an adjustable, we'll give you the information on who the index is. You can follow it online and kind of see where your adjustments are taking you. But index plus margin equals interest rate. That's the idea of an adjustable. All right, so some of you have heard of the term PMI or MI, mortgage insurance, private mortgage insurance. Basically, PMI is a requirement when you don't have 20% down on a home. Now, let's be honest, most first-time home buyers, we don't have 20%, especially in this LA market. Most of us are going to have that 5%, 3%, 10% down. So you're going to have PMI. Now, what I've seen, most people, they hear the word PMI and it's automatically like a negative thing. Oh, I don't want PMI. But again, saving 100, 200,000 for 20% down in this market, it's a little harder to do. Having PMI shouldn't discourage you from purchasing a home. PMI is basically extra insurance that you pay for that protects the lender just in case you walk away from the property or default. So PMI in the conventional world is really credit driven. An example below, you're going to see on a 350,000 purchase with 5% down, this 0.49% calculation is for credit around 740. If your credit's above 760, it could be even less than this. So 332,500 would be the loan. If you put 5% down, we're going to multiply that by that 0.49% divided by 12, and you have your PMI. PMI also works in 5% increments, right? So let's say you're putting 5% down, you're going to have the highest rate of PMI. 10% is going to be a little bit lower. 15% is going to be the cheapest. And honestly, sometimes the sweet spot is that 15%. The difference between 15 to 20% could mean 40, 50,000. So sometimes we'll explore the option of, hey, maybe we'll do 15% if you can stretch it. And this way, you'll still get very low PMI, but not deplete all of your savings for the down. An impound account is where and I'm going to, on the next slide, it's going to be a little bit easier because you're going to see the breakdown of your housing expenses. The impounds is where basically the lender takes care of your property taxes and insurance. Essentially, what we do is we take your tax rate divided by 12 and we add it to your payment. Same thing with insurance, whatever that is, divided by 12, add it to your payment, and then the PMI or mortgage insurance will be paid. So what you're gonna do is you're gonna pay us a certain amount. We're gonna save for property taxes that are due in December and April, and then homeowners insurance that's due once a year when you buy the home. And we're gonna pay PMI monthly. An impound account is required when you don't have 20% down. So most of us, we're gonna have to have impounds. And on this next slide, we're gonna see the breakdown of your monthly payments. So when you say, oh, my mortgage is, let's say people tell me my mortgage is $5,000, $4,000, $3,000. There's a breakdown that happens there. And in this example, we're going to use 500,000 for our home price with 5% down. So our mortgage will be for 475,000 with a rate of 3% on the 30-year term. Pretty straightforward. The principal and interest payments, the $2,003, that covers the payment to the loan. Property taxes. Some of you may be on Zillow or Redfin looking for homes and browsing. I know a lot of places have these calculators. If you want to calculate more accurate numbers for property taxes, use 1.25% of the purchase price as a calculation. So in this example, it's $520.83. Homeowners insurance, we can guesstimate. I usually put a flat figure, 125, 150 bucks, just depends on how high you're gonna purchase. But on this example, 125 is perfect. Homeowners insurance is something that you're gonna shop for when the time comes. You're gonna give us a policy, we're gonna use that policy essentially. But to have a good idea of what your payments are gonna look like on those online calculators, I would suggest put 125, 150 bucks. Unless you're buying near a fire zone, flood zone, which isn't that common, but we'll just say 125 bucks should cover it. And there's your mortgage insurance. So essentially, you pay us $2,842, out of which we pay the PMI. We save your homeowner's insurance, save the property taxes. When they come due, we pay them through this impound account. All right, so a lot of times, at least in my experience, when I'm talking to homeowners or home buyers, the rate is the number one question, which is important, right? Of course, rate determines what your monthly payments are, but a lot of people forget or don't put enough weight on fees, right? So let's just say, for example, I give you a quote at 4%, right? You'll never see someone else, another bank, credit union lender, give you a quote of 3%. You'll never see that big of a difference. That's dramatic. When we're all attached to the same market, we all work with the same investors. It's more realistic if we, let's say, quote you at 4%, someone else comes in at 4.1 or 3.8, 3.7, then that's more realistic. But the second question I always say for home buyers to ask is, what are the fees involved, right? Because you're going to have lender fees, which we're going to see on the next slide. But then there's third-party fees in a purchase, right? There's appraisal, title, escrow, recording. Mainly the big chunk, the 6,000 that you're seeing here is mainly your title and escrow fees. Title and escrow is determined by the seller of the property. So essentially you have no say and you have no control on what these fees are going to be. You put an offer, it's accepted. They're going to say, here's title company, here's the escrow company, go open escrow with them. So no matter who you work with, that portion, imagine, is going to be the same. So we're guessing about 6,000 or so on a $500,000 purchase. And one thing to keep in mind, these fees are on top of the down payment, right? So whatever the down is, a 3% or 5%, you're going to have these fees on top of the down. So you need to budget for a little bit more than just the down payment. Prepaid items, I'm not going to go too into depth with this right now. Maybe confusing for some, especially if it's your first time, but there's a certain amount of months of your property taxes and insurance that we have to collect upfront when you first set up a loan. Depending on the timing of the year, it will tell us how many months of your taxes we need, how many months of your insurance we need. And we're going to estimate about 2,000 or so, 2,000 to 3,000 on this example. This is what I'm talking about when I say fees, right? So what are the lender fees? Because again, let's go back a slide. The third-party fees are out of our control, going to be about 6,000 or so. No matter who we work with, it's going to be the same. But the lender needs to disclose what their fees are. So you're asking about rate. Good question. What are your lender fees? With Foothill Credit Union, pretty straightforward. $700 processing fee, no other hidden fees. Some other lenders, and I've seen this happen a lot, they will put an underwriting fee, then a processing fee, then an administrative fee, loan document fee, you name it. And it all adds up. And I've seen in my experience anywhere between $1,200 to $2,000. It all depends, right? So it's important to question the lender's fees. Hopefully you're working with me, but I do encourage shopping here and there. It's good to keep your options open. I'm very confident with Foothill Credit Union's fees. That's why I say so. And you can earn some credits by completing 3 modules. Now the modules, they're educational, talking about buying a home, mortgages, considering homeownership. You don't need to do these now. When the time comes, when your offer is accepted somewhere, I'll give you the link. I'll tell you where you need to go, but you can earn $250 per module. And by attending our seminar tonight, you all will receive an additional $250 towards your closing costs. So imagine you have 700 in fees plus the 6,000 plus the 2,000. It all adds up. Getting $1,000 off wouldn't hurt that much. It would actually be good. So yeah, please keep that in mind and talk to me about it when the time comes. All right, what's an escrow company, right? So some of us have heard the term, oh, my property's in escrow. Well, escrow is a neutral third party that handles all the money in the transaction. So picture this. So you're the buyers, you have your real estate agent, there's the sellers, their real estate agent, and then there's me, the bank providing the money, or the credit union providing the money. Escrow is kind of right there in the middle, coordinating all the money, right? They're going to take your down payment, they're going to take our loan, they're going to pay off the seller's loan if there is one, and they're going to give us a detailed accounting of where the money went. We call it estimated settlement statement. So escrow is in charge of the money. They're neutral. They're handling everything and giving us documentation at the end to show us what we paid in fees. And they also assist with the final document signing. Title and escrow go hand in hand. So imagine the best way I describe title is pink slip to your car, title to your house. When we as a lender are going to put a loan against the property, we're going to have escrow open title and do an extensive search on the previous owners. I want to see if there are any liens tied to the property, if there's any mortgages, any judgments. Nowadays, you don't pay your taxes. You could get a lien against the home, depends on the amount. You don't pay your contractor, they can put a mechanics lien. We want to make sure you're taking ownership of this property, the clear title report. And you're paying for title insurance because if something pops up in the future, this title insurance will kick in and cover it. So escrow and title go hand in hand. In any real estate transaction, whether it be a purchase or a refinance, there's going to be an escrow and title involved, always. And these are the third-party fees that we were talking about earlier. All right, you guys. So steps to home ownership, pretty straightforward. First things first, pick up the phone, come in, make an appointment, talk to me about a pre-approval. Now, there have been times where I've worked with people for a year, couples, individuals, 6 months, a year and a half. I had an escrow open today. I've been working with them for a year and a half. If you feel like you're not ready, oh, my credit's not good, Vaughn, or whatever the case, still take that step if you're showing interest in buying a home. I can help you or give you my opinions and guide you through what you need to do if you're not ready, or point you to the right direction. And I get that with most first-time home buyers is you don't want to ask too many questions. They don't want to sound like you don't know something and it's such a big purchase. Like, I don't know if I can do it. You'd be surprised. And again, calling me, spending 30 minutes on the phone with me is going to help you understand better what your situation is like. And if we can't buy right now, we can buy a little bit later. We'll get you to that point, or I'll get you to that point. After getting your pre-approval, you're going to work with getting a real estate agent or a realtor. I would suggest, I know a lot of us know family and friends, definitely, want to give them the business, but also at the same time, maybe take a couple of different options and shop around for this real estate agent. See, when you're buying a home, the seller of the property pays for your agent's commission. So you're essentially, you're not paying them anything. They're representing you for free. They're going to get paid from the other side. And you want to get someone that knows what they're doing, right? You know, someone preferably a little seasoned in the market, but also is familiar with the area, familiar with how to present an offer, and they're going to be representing you out there. So find someone you're comfortable with, you have a good vibe with, they're responsive, because again, this process sometimes could take a few months, and we want someone that's there to support you, like I'm here to support you on the loan side of things. So you find the agent, you get your pre-approval, you see your property you like, you're going to make an offer. If all is well, they're going to accept your offer and they're going to have you sign a purchase agreement or a purchase contract. Around steps 4, 5, 6, 7, I'm going to kind of like lump it in. So around this point, I would say, bring me in, tell me that your offer is accepted, have your real estate agent send me a copy of that contract, because right around that time, you're going to be sending your earnest money deposit, right? Usually an earnest money deposit can be anywhere between 2% to 3% of your purchase price. And this earnest money deposit will be counted towards your down payment. So it's not in addition to it, right? So you got your 3%, 5% down, your closing costs, but you're going to put a portion of it up front, kind of like a good faith deposit to get escrow and title to be opened. And right around that time, we're going to talk to me about rates. Unfortunately, with pre-approvals, rates aren't locked in upfront. So we want to get the pricing, know where you're at, lock in an interest rate. And I'm going to be giving you some updated or a list of updated documents I need from you, pay stubs, W-2s, if I don't have them already, and bank statements. Once we have escrow open, deposit, and locked in your interest rate, I'm going to have you sign your initial loan disclosures. Now you can do that in person, or we can do it through DocuSign. A lot of signatures, a lot of sign here, sign there, a lot of disclosures, but I encourage you to call me to go over these papers, since it'll be the first time you're seeing them. And again, we're here to help as best as I can. So the processing of the loan begins. We order the appraisal right after you sign these papers. So this is like, imagine the first week, week and a half of your escrow period. So what I mentioned earlier about doing a lot of legwork, going back and forth, it's going to happen within this first week, week and a half. And then after the appraisal's ordered, you kind of sit back and wait for everything to finalize. There will be one of my processors assigned to the file. They might have some questions. They're going to reach out. We're going to introduce them to you. But the stressful part is the beginning week, week and a half. Prior to closing, you'll have a final walk through the property, and this is done with your real estate agent. So this happens a day or so, like the week of closing. Then you're going to sign your final loan documents with that escrow officer. They can maybe come to you, or most times they ask you to go to their office. And they'll have our loan documents, they'll have some escrow documents, they're gonna go over everything. And if you're signing during business hours or even after, I'm available to help with any questions. But by that point, all of your questions should have been addressed. So it's just a matter of signing your life away, those 150 pages, and becoming a homeowner, essentially. Around the time when you sign your loan documents, depending on the escrow officer, they're gonna ask you to send the remainder of the money. Right, so you put your earnest money up front. Let's say let's call it 15,000. You're going to need another 20,000 to close at the end. You're going to send that wire to escrow right around the time you sign your loan documents. And we'll turn around and fund the loan, meaning we'll send our money over to escrow. They'll take our down, your money. Sorry, they'll take your down, our money, pay off the sellers, just how I explained earlier, and everything will be finalized and recorded with the county. Step 12 is escrow, dispersing all the money to everybody and closing the transaction, essentially. And that's it. Congratulations, you are homeowners. I know I make it sound simple. It kind of is. I know I do this on a daily basis. It's not as complicated as we've all heard. It's not a difficult process. I really strongly believe it's who you work with that can make this an easy process for you. So please, if you have questions, you're not ready yet, whatever the case is, please reach out to me. I'm more than happy to assist and get you to that point to become homeowners. You can contact me. Well, my direct line is not here, but my extension 6236, or just shoot me an email or go online, put your application through. If you prefer an in-person appointment, we can definitely do that. I'm in the Arcadia branch. But if you prefer a Zoom call or a telephone call, we can do that as well. And you have contact info for John. He's my manager here, but definitely go through me first. And that's it, you guys. Thank you all for listening. Yari, do we have some questions?
Yes, we do have a question. So the question we have is, what is the difference between installment loan and personal loan? And is one more significant than the other?
It's actually one and the same thing. An installment loan is an agreed upon term. So a personal loan is an installment loan. A car loan is an installment loan. Excuse me. It's an agreed upon term. Make your payments on time. Everything's fine.
We do have one more question. The question is, any tips for finding real estate agents?
Ask around. A couple people. I have a couple real estate agents I work with. I wouldn't say just jump on Google and find anyone, but ask me. I can refer a couple people over that I've worked with over the years and know what they're doing. Ask family and friends. But again, choose, take a couple different options and choose someone or one of those options, but interview them. I call it an interview.
We have another question. So does Foothill offer any special loan programs for educators?
Unfortunately, not yet. We don't offer anything special for educators. I mean, we are a closed membership credit union, so we try to put our best foot forward when it comes to everything for our educators and our hospitals and nurses we work with, but we don't have any special programs for educators just yet.
Next question, is it wise to use a 401k loan since you're essentially paying yourself back and use that money for a down payment?
Definitely. I mean, the money is sitting there, right? It's growing. You're going to contribute to it. You're paying yourself back, yes, with interest. But with 401ks, most times you can get a pretty long term, meaning you're not going to see that much of your paycheck be deducted. And it makes sense. Like my 401k, I think it was like 15 years I could get a loan for. So I'm not going to see that much of a difference in my income, but I'm welcome to pay it back sooner. So yeah, I mean, if you have money in the 401k, use it to help you buy a home. This is the best investment you're going to make long term, and you're going to see it pay off.
Another question we have about 401k is, if I'm planning to use part of my 401k, if I'm planning to use part of my 401k, how much of the 401k can I use? And do I need to liquidate the assets and have money in the bank before you evaluate the loan amount?
Good question. No, so we don't need you to liquidate anything, move anything around from 401ks. Different companies, depending on how many years you're with the company, I think I would check with your 401k, but different companies allow you to take a certain percentage out. So you can't, it's not like you're liquidating the whole thing. It's not like you're withdrawing. I mean, some companies let you do that. I would suggest the loan option versus just taking a hit and taking the money out, but you don't move money around until your offer is accepted. But when you meet with me or talk to me, I'll ask you for that 401k statement just to make sure that the money's there. And then when the time comes, your offer is accepted. Typically 401ks take about a week or so to release the money, and most escrows are 30 days. So you'll be okay. The only thing I have to point out, if most of your money is coming from the 401, if all of it is coming from the 401, that earnest money deposit is something that's required within the first 3 days of escrow, right? So it's hard to know when your offer is going to be accepted, right? Maybe we'd have to plan a little bit more ahead of having at least that earnest money, because it's going to take your 401k at least a week to give you that money. So kind of plan for that.
Next question, how does the first time buyer program come into place with all of this?
Well, when I hear, I'm gonna do my best to answer, and if I don't answer, please do a follow-up question. But when I hear first-time buyers program, most times they're referring to an FHA loan, right? So there's two mortgage types out there. There's FHA and then there's conventional. For the longest time, FHA was the only program available that will let you put as low as 3.5% down. Conventional used to be 20%. Recent years, conventional has become a lot more competitive. So you can get in with 3% down on a conventional. Now, your situation, I may be going a little bit off topic here, but your situation is going to dictate which is a better option. Not always is FHA the best way to go. And I know most people are programmed and heard, from parents, family, whatever, FHA is good. Conventional is good too. FHA has good and bad, both. I mean, it's one of those. Your situation dictates which is a better option. So you're not going to lose out on something if, let's say, you take a conventional loan versus FHA. Types of properties come into play with FHA. It gets more, call it scrutinized a little bit on FHA side, but I'd like to talk to you about your situation and tell you what's a better fit for you.
Awesome. So next question, does this also apply to buying a mobile home?
We don't do mobile home financing. It's a similar process, similar concept. With mobile homes, in my experience in previous years of working on mobile homes or manufactured homes, you need to meet a specific criteria. There's three things actually. The mobile home must be a double wide. It must be built after 1976. And the most common, the hardest thing, at least around our area, is it has to be permanently fixed on the foundation. Now, I've heard of lenders out there that will let you still get a mobile home loan, but when the land is leased and not fixed, but for the most part, it has to be fixed on a permanent foundation. So you must own the land, you can't lease it. And that's been the case most lenders that I worked with in the past. And around here, I'm not too familiar with too many mobile home parks, but I believe the ones that I've come across, all of them are leased land. You don't own the land.
Awesome. So next question, realtor or real estate agent, which is better?
Realtors have to be a part of an association. Honestly, they're almost one and the same. I would focus on the individual versus the title, because you're gonna have that person doing all the legwork for you. So if you got someone that is I like to say a hustler, right, on top of things, calling you back, who cares if their title's real estate agent? Realtors are held to a little bit higher standard. They're part of this association. They pay some dues to be a part of it, but don't focus on the title. It's the individual you're working with, how good you and that person communicate, vibe, all of that. I would focus more on that versus the title.
Great. And then next question, if we are already in the home buying process, got pre-approved and are already looking for the house, will it be okay to still reach out to you?
Yeah, definitely. I mean, I'd love the opportunity to earn your business. More than likely, the amount that you're approved for, it's going to be similar to mine, but it doesn't hurt to shop around and see. A lot of times, lenders charge extra fees, points, and I'll give you more information. But yeah, I will encourage shopping, and why not? Maybe on this side of things, your rate will be better. The experience definitely will be better. But yeah, definitely don't let that stop you from holding or calling me or emailing me.
Next question, what if my 401k is with a previous employer? How do I pay it back? Should I move the 401k somewhere else?
Honestly, when it comes to that, I'm not too sure. I don't think you can borrow if it was with the previous employer. I think you have to roll it over somewhere. I would contact the company that holds the 401 and ask them directly. I'm not sure how it works when it's your previous employer, I'll be honest.
Next question, are we limited to where we can buy a home going through Foothill?
California only. I would say anything out of state, unfortunately, can't help you out with, but California, all over California, we can do.
Next question, why would you not go for an adjustable rate and then refinance later compared to a fixed rate?
I mean, if you ask me, I mean, I ask the same question to people, why wouldn't you? It's riskier. The people hear the word adjustable and right away it's like, oh, I don't want adjustable. The 2008 meltdown really put a bad taste in people's mouths because of that adjustable. Like I said, there's different types of adjustables out there. I would buy on an adjustable. I'm comfortable with it, but also, I'll give you all the facts and you can make the decision. I think an adjustable rate, paying a little bit lower interest rate, why not? Why lock yourself into a 30-year fix? Most people, 90% of people are not going to keep that loan for 30 years. So my thought process is if you can afford it, If you calculated risk, that's what I was looking for. If you can take a calculated risk, I mean, of course, we don't know what's going to happen in 5 years, 10 years, whatever amount of time, right? But if, let's say if you're a doctor, you're a nurse, you know, we have a stable job, you're a teacher, or you're confident, you know, you have your savings, whatever the case, I would suggest doing an adjustable. Now, sometimes the adjustable, you can't qualify for as much because when we run the numbers on adjustable, we have to qualify you on the worst case rate, right? Usually these adjustables have a cap, like the highest rate could ever go if it adjusts after that fixed period. So typically, if your income is, we're barely making it on 30-year fixed for whatever 500, 600,000, the adjustable is going to cut your qualifying. So that's one downside of it. But again, everyone's situation is different. So ask me that question when we're talking and we'll run the numbers and see. I think it's a good program. You can always refinance out of it. And you can pay a little bit lower interest rate since rates are on the rise.
Awesome. So next question, what is the current average interest on a home loan?
Here's where qualifications come into play. Credit really matters, but we're sitting today's rate on a 30-year fixed, we're sitting around 4.25, 4.375. And that could go up. It can go down if you pay extra fees for it, but it could go up if your credit's not strong enough, if it's not in the top tier. But on average, we're around like 4.2, 4.3 this week.
Great. So next question, how does an auto loan impact the house loan?
Not necessarily an impact. I mean, it's the payments, right? So when we qualify you, that one screen, the housing expense screen. Okay. So when we qualify you, we look for minimum payments on credit cards. So like utilities, cell phone bills, stuff like that don't count. So a car loan is one of them that shows on your credit, right? Credit cards, minimum payments, installment or personal loans, student loans. So we add up those payments and then what the mortgage payment's going to be. Now, the only way the car loan could affect the credit essentially is if it's a $400 or $500 payment, it wouldn't affect the credit per se. It would take away from what you can qualify for. I mean, we all need a car. If you need to buy a car cash, even better. But if you need to finance it, we're just going to have to work around it and see, okay, well, with this car, what can you qualify for? And I can run a hypothetical and say, if you didn't have this car, if you sold it or refinanced under someone else's name, you'd qualify for more. So that's where the car would have an impact. Other than that, make your payments on time. It's not going to negatively impact you.
Great. So next question, with current local home prices ranging from 800K to 1.5 million, can you give us an example of what an average monthly mortgage payment might look like?
Yeah, actually, well, I mean, I can go on the higher end and show you what it looks like. 1.45 with 20% down, so 1,450,000 with 20% down was sitting right around with taxes and insurance about 6,900 roughly. $1 million home, we're probably going to be closer to 5,500 or so. It depends on the interest rate and the PMI and all that, if there is PMI, but anywhere between, let's call it 4,500 up to 7,000 would be on 800,000 plus home. A big portion of it, sorry, Ari, are your taxes. When you're buying that high, again, go back to the slide. When you get the video, it's 1.25%. And you'll see on $1 million home, 1.25%, huge chunk of it's like over $1,000 a month, just taxes alone. So it's not necessarily the loan payment that's a lot. It's property tax and insurance. And if you put 20% down, you can pay your taxes separate on your own every 6 months, and your loan payment will be less. It'll be in the 3,000s on something like 800,000, or sorry, like high 2,000s on something like 800,000, all depending on the interest rate. But since I don't have my calculator with me, I can't give you guys exact numbers, but that 1.45 was at the higher end. I had an offer accepted today on that. That's why I know it's about $6,900 for that with tax and insurance included.
Awesome. So next question, what credit score do you need to start looking?
Anything above 620, I would say. And again, like I said earlier, Don't let the fear of your credit being too low hold you back. I mean, worst case, we run it, comes in lower than that, can't do anything for now, but at least we're going to see what's dragging your scores down. Is it the lack of history? Do you have late payments? Do you have collection accounts? Honestly, a lot of times I see collections people didn't even know about. And it could be something as small as a co-payment on a medical, like $100 copay, forgot to pay, or insurance didn't cover, they didn't notify, whatever the case, it went to collections. So Credit Karma, NerdWallet, Experian, all those monitoring services give you a good idea, but it's not going to be as accurate as when I run it, right? Because some of those agencies, they won't have all three credit bureaus there. It'll be maybe one or two, or they'll miss something and they'll show me 700 scores. I run it, it comes in lower, or vice versa. The only way to know is to try it. And I mean, if you're already thinking your credit's not that good, one check or two credit checks is really not going to hurt your scores like that. People think that running credit is going to drop it multiple points. Not necessarily, could be a few points here or there. Mortgage credit reporting is a little bit different versus applying for a car loan, getting a credit card, all those other things. So yeah, as low as 620, if you're below 620, you know you're below 620, you just don't know what to do, how to start, what advice, call it, you need, we could still run it and see. I'm open to that. At least it'll give us a base to start and we can work our way up from there.
Great. So next question, is your credit affected every time you get pre-approved? Meaning if we tried to shop around with different lenders, what would that look like?
Good question. Credit scores. So with mortgage checks, you typically have 3 times in a month to run your credit on a mortgage inquiry, and it's not going to really hurt your scores. And most people avoid running credit because they think it's going to drop their scores. I mean, 2 to 3 places, checking, shopping should give you a good idea what's out there. You don't need to go more than that. Again, we're all attached to the same market. We work with the same investors. There's a little bit price differences here or there with rate, fees. We're going to compare it all. So if you're checking 2 to 3 places, it's plenty. And if you do that all in a 30-day window, your scores are not going to drop. Maybe a few points here or there, but that's not really going to make a significant difference.
Okay, great. So next question, does exceptional versus very good make a difference in loan interest rate?
So the cutoff, and I'll give you examples. So the top tier, highest tier, 740 and above for interest rates. PMI is 760 and above, but every 20 points, it makes a little bit of an impact. So 740 versus 720 versus 700 versus 680, 660. So yes, I mean, if you're 660 versus 720, there's going to be a big impact on the interest rate. But again, we'll run it and see, and your situation is going to tell us if you're going to get FHA or conventional in an instance like that. So higher the better, you guys. And again, practice good credit habits and try to pay things off at the end of the month. I know it's easier said than done. If you have lack of credit, see if you can get an authorized, be an authorized user on someone's credit or open up a secure credit card. You got to start from somewhere, but seeing it in front of me will help me tell you exactly what you need to do.
So next question, if I filed a bankruptcy 9 years ago, should I wait to look for a house once it falls off in year 10? Or how much can that impact what we are approved for, especially if my credit now is above 740 and my husband is above 800?
I wouldn't wait at all. You've waited plenty of time. In the conventional world, 4 years, up to 7 years, depending on the type of bankruptcy it is, but you guys are way past that. So no, I mean, even if it does show up, your credit, as you said, 800, 700s, you're there. I mean, we're not really gonna look at it as a negative thing if it shows as a bankruptcy. It shouldn't show actually after 9 years. Typically it's 7. But if you're at 9 years, yeah, definitely don't wait any longer. Let's check it and see. Worst case, we can't do it now. We'll come up with a game plan when we can. But it seems like you can if it's been 9 years.
Awesome. So next question, if you just refinanced your car loan recently and got a credit card with Foothill, can you still try to get pre-approved?
Yeah, definitely. The consumer loan products, they use Experian to check your credit. I use all 3 and I use a different system. So I know it's all Foothill Credit Union, but my credit reporting is more detailed. It's separate. So it's not like I can excuse me, I can't, and I could see what they ran on the consumer side of things, but I'm gonna run it on my side just to make sure. And if it's been within the 30 days, maybe we wait for that 30 days to pass because credit resets every 30 days and we'll check in next month. If you did it this month, let's check the beginning of April. Let's see.
Great. So last question for the presentation tonight is, are there any homes available under 600,000?
Depends where. I've seen some. I mean, if you're willing to go east, San Bernardino County, Riverside County, there's some actually beautiful homes out there. Victorville, if you're willing to go up there. If we're talking LA County, not below 600 in today's market, you might find something that's a steal under the 600,000, but it'll probably need a lot of work. But if we're talking Pasadena, Arcadia, LA, Glendale, Burbank, Sylmar, like those areas, all of the valley, San Gabriel Valley, San Fernando Valley, it's gonna be tough. You're gonna have to probably go out to the San Bernardino County and Riverside County to find something around 600, and it's doable. I've seen some in Pomona. I've seen some in Ontario too. So Redfin and Zillow, they'll tell you guys.
Okay, great. So that is all the questions for tonight. Thank you everyone so much for joining. If you did join late, we will still see that you joined the seminar tonight, and you will still get credit for the $250 off the closing cost for attending tonight's seminar. So, but thank you everyone so much. If you guys have any more questions, again, please feel free to reach out to Vahan. And we hope you guys have a great night. So thank you.
Thank you guys. Take care.